In fact, silver had a net up year, like a couple percent last year versus where it was in 2021. Wild child that it is.
Michael Oliver discusses the performance of gold and commodities in the market. He explains that while gold is not necessarily attached to commodities, it doubled in price while most commodities remained at their low between 2015 and 2020. He also mentions that most commodities have been in a downward process since the pullback that started shortly after the Russia-Ukraine conflict in February 2022.
We think a lot of the big pieces of this puzzle that are floating around, the stock, the bond market, commodities, and gold. Gold is not necessarily attached to commodities, by the way. Gold doubled in price while commodities stayed the sewer, okay? Between 2015 and 2020, gold doubled and commodities were still at their low. The pullback we've had in commodities, by the way, which began shortly after the Russia-Ukraine conflict started, which is February of 2022. If you look at the commodity index, Bloomberg Commodity Index, or price of oil, or many commodities, you'll see they peaked then, soon thereafter, a week or two later. And since then, for over a year, most commodities have been in a downward process, not the kind of process that erased the gains that we saw. We put out a buy signal in October 2020. At that point, Bloomberg Commodity Index was 70. It doubled. It went to 140 by early 2022. Most of that prior to the Ukraine event. Okay. So that wasn't the reason. And then we've had a year-long pullback in the Bloomberg, such it's trading right now around 105. So it's not back to the 70 price lows of 2020. It's pulled back, and it's been really an arduous pullback, an overlapping. It's not been a collapse. It's been an arm wrestling event. And it looks to us, and we haven't signaled it yet, both oil and Bloomberg Commodity Index have some numbers just above them. In fact, oil went up to the numbers this week and then failed at it. Just above 80 in oil. I want to close a week out up in there. And the Bloomberg up around 109. Right now it's trading 105 and a half. I think the high this week was something like 108. So just above the current market, both on the Bloomberg Commodity Index, the broad metric, and crude oil, they both have some trigger levels that tell us that this corrective process that we've been undergoing for over a year is over, and they're resuming an uptrend, the longer-term uptrend. Now, when think about that for a minute. Your assumption right now, if you're a stock investor, is that, oh my gosh, if commodities start back up again, if the price of gasoline goes back up again, you know, the nightly news about how it's pulled back, and oh my gosh, the Fed's going to keep the QT tightening going. They're not going to shift their policy. They're not going to soften. They're going to be ambushed by a commodity resurgence again. Okay, interesting assumption. That's one big piece of the puzzle, because that should be bearish for bonds, meaning we're going to get higher yields. Bond prices go down and stocks go down. So it's a nightmare for them to think commodities will go up. But in fact, I think what's about to happen, our assessment is this, that the joining at the hip of bonds and stocks over the last year or so, where they both gone down sharply together. Bonds, for example, last year were down like 30 some odd % in price. Look at TLT, for example, popular long-term bond ETF. Was down, I think, 33% from 21's close to 22's close. S&P was down 20% last year. That was a rally late in the year. NASDAQ 100, the leadership index, was down 30-something %. Huge losses on both sides of that balanced portfolio, 60% stocks, 40% bonds. So anybody in the normal portfolio got massacred last year.
Michael Oliver talks about the correlation between bonds and stocks in the market. He explains that both stocks and bonds went down sharply together last year, causing huge losses on both sides of the balanced portfolio. However, he thinks that the bond market bear is about over and is going through a basing period.
We think, though, that when we examine the T-bond market, we think that it may have made its low, or if it makes a new low, meaning one more rise in yields on the long end, we're talking 20-year on out, it'll only be marginal. We think the T-bond market is actually, in fact, if you look at a price chart of TLT, it's back down to the 2009 levels where it was then during the crisis. Okay, so if the stock market had matched what bonds did over the last year and a half or so, the S&P be trading about 1,500 Okay. So the stock market is not nearly matched what the bonds have done. We think the bond market bear is essentially about over, and we think it's probably entering a basing period. Why would bonds start to level off in price and maybe drop in yields, let's say later this year? If you had a commodity upturn again, and the Fed were under, therefore, policy pressure not to loosen. And of course, that would hurt the stock market, but the bond market's already taken its punishment in our view. We think it's basically done, so that the linkage between bonds and stocks, which hurt people last year, will not hurt them this year. This year, I think by the end of 2023, you'll probably make money in bonds and lose a lot in stocks. So that's those two big pieces of the puzzle, I think, are about to separate. Most people, I don't think, are anticipating that. Why would bonds stabilize and go up if, in fact, commodities have another leg up? Because it doesn't make sense when you think it's a Fed-only issue, because the stock market takes a dive.
Michael Oliver talks about the possibility of the stock market rolling over again and how investors may feel disappointed as a result. He discusses the potential massive liquidation of assets out of that sector and how economic data points may lag to the market and join in.
So we called the top in the stock market. It was January of 2022 in the NASDAQ and February of 2022 for the S&P. They were just off their highs, which occurred in late 2021. We said that the first leg down would be an arm wrestling match, not a crash. And sure enough, if you look at a price chart of S&P or NASDAQ, while net on balance, it was a pretty big drop for the year, it was an arm wrestling decline, overlapping rallies and so forth. So it teased you all along to the point now where people are using the word bottom again. It's bottoming. We're going to have a soft landing, all this kind of stuff. What will shock people is if, and we think the technicals will bear this out, that the stock market, in fact, rolls over again to the point where, and it's not far below current levels, we think it will be triggered, where then the investor who's full of hope now that this was merely a fake out sell-off and the stock market's going to resume its big bull trend, they're going to be disappointed. And once that disappointment hits that market and the doubt about whether it's in the downtrend or not suddenly shifts back to, yes, it's really in the downtrend, that's when you get a more massive liquidation of assets out of that sector. And also, you'll probably get data points, economic data points that have not indicated negative, will suddenly at that point, lagged to the market, will join in. That's the way it usually happens, by the way. Usually the data points don't lead the market leads the data points. At that point, the central banks of the Western world, including Japan, let's say, and the ECB, and of course the Fed, will have to seriously consider that regardless of a recovery in commodities, that debt markets, corporate high yield corporate debt, which got hammered last year, muni bonds, treasuries need to be supported because revenues to the IRS may be less this year because nobody had capital gains last year, 2021, 2022 anyway. So suddenly the Fed's going to be facing a different set of fundamentals. Yes, they're going to have commodity resurgence, but they're going to have weakness in the stock market and economic factors that counterbalances that, to where they have to move in back to what central banks traditionally, what they were made to do, and that's support the government debt markets and support the paper markets that government deems to be important, like the stock market.
As we come to the end of this video, I hope you found it informative and thought-provoking. If you have any thoughts or questions about the topics discussed in this video, please leave a comment below. Don't forget to like and subscribe to stay up to date with our latest content. See you in the next one.